See, the following figures are available from the financial records of ABC Manufacturing Company Limited for the year ended 31/3/2013. Sales 20,000 units, 25 lakhs. Material 10 lakhs. Wages incurred 5 lakhs. Factory overheads incurred 4.5 lakhs. Office and administrative overheads incurred 2,60,000. Selling and distribution overheads 1,80,000. Finished goods 1,230 units, 1.5 lakhs. Work in progress material 30,000. Labor 20,000, factory overheads 20,000, therefore WEP 70,000, goodwill return of 2 lakhs, interest and capital 20,000. These are only financial items. Goodwill return of interest and capital. In costing records, factory overheads to be charged at 100% of wages and administrative overheads 10% of factory cost. Selling and distribution overheads at the rate of 10 per unit sold. You have to prepare a statement of reconciliation as per cost records with profit as per financial records. So we have to prepare trading and P&L account, financial and a cost sheet in cost accounts. Then the third stage we have to reconcile it. Let's see one by one. First trading and P&L account. So financial profit we have to find out. So trading and P&L account. Trading and profit and loss account. Right. So what are the items to be placed in trading and profit and loss account? First items already given. So opening stock not given, closing stock is given, opening stock not given, therefore dash. Material given, material 10 lakhs, 10 lakhs. Wages given 5 lakhs, wages given 5 lakhs. Overheads, factory overheads given 4.5 lakhs. These are all incurred expenses in financial accounts. Factory overhead incurred given. To office and administrative overheads given. Office and admin overheads given. Office and admin overheads 2,60,000 given. To selling and distribution overheads. Selling and distribution overheads 1,80,000 given. So these are the items in financial accounts. Simply trading and P&L account we have to prepare to find profit as per financial accounts. Selling overheads 1,80,000 given. To goodwill return of, this is only purely financial item. Goodwill return of 2 lakhs. Goodwill return of 2 lakhs. To interest on capital. To interest on capital. So interest on capital 20,000. So these are purely financial items. Right. Next, by sales 20,000 units we sold. It is given 25 lakhs. By closing stock, finished goods given, WAP given. Finished goods for 1,230 units. 1,230 units finished goods 1.5 lakhs. 1.5 lakhs given. 1.5 lakhs given. WAP 70,000 given. Right. Now you simply make a total. 27 lakh 20,000. So 27 lakh 20,000. Missing figure 1,10,000. So that is financial profit 1,10,000. Financial profit 1,10,000. Right. Step number 2, cost sheet you have to prepare. Right. So cost sheet, direct material consumed. So direct material consumed. If not given now, financial we can take as it is. 10 lakhs. Direct wages not given now. In financial we can take, that is 5 lakhs. We can take as it is. Direct expenses, that is royalty on production, machine hiring charges. So those items are not given. Therefore dash. If you just add these three things, you will be getting prime cost in cost sheet. that is equivalent to 15 lakhs, that is equivalent to 15 lakhs, 15 lakhs, 15 lakhs. So 15 lakhs prime cost. So prime cost 15 lakhs. So add factory overheads, add factory overheads. Here condition given. So factory overheads to be incurred 100% of direct wages, 100% of direct wages. So direct wages is 5 lakhs, 5 lakhs. 5 lakhs into 100% we have to take. The point is given in the paragraph, 5 lakhs into 100%, that is equivalent to 5 lakhs, 5 lakhs. So answer gross factory cost, gross factory cost, that is equivalent to 20 lakhs, 20 lakhs. So gross factory cost 20 lakhs. So add gross factory cost 20 lakhs, add opening WAP, opening work in process not given dash, less closing WAP, that is given, less closing WAP, that is equivalent to 70,000 given. Answer net factory cost, answer net factory cost, net factory cost 19,30,000, 19,30,000 net factory cost. Right. Now add office and administrative overheads. Add office and administrative overheads. So add office and administrative overheads. Office and administrative overheads are 10% of factory cost. 10% of factory cost. Factory cost means here net factory cost. Net factory cost into 10%. 10%. That is equivalent to 1,93,000. 1,93,000. Just to add. So you will be getting cost of production. You will be getting cost of production. You will be getting cost of production. Cost of production 21,23,000. 21,23,000. 21,23,000 cost of production. This cost of production you have to add opening finished goods. You have to add opening finished goods FG. Opening finished goods not given, therefore dash, less closing finished goods. Yes, we have to find out. So now cost of production is nothing but 20,000 units sold plus 1,230 units closing stock. So overall 21,230 units. This is cost of production. This is sale units. This is closing stock finished goods. This is production. This is production units. So production is 21,230 units. Right. How to find closing stock? So 21,230 units. Okay, we have a cost of production of 21,23,000. 21,23,000 cost of production. Then for 1,230 units. Okay, for 1,230 units. Okay, what is the cost of production? What is the cost of production? We have to find out. Here 1,230 will go up. 21,230 will come down into 21,23,000. 21,23,000. So the answer for closing FG 1,23,000. 1,23,000. So answer 1,23,000 approximately 1,23,000. Right. So this item you have to subtract. So after subtracting, you will be getting a term cost of production plus opening FG minus closing FG is equivalent to cost of goods sold. Cost of goods sold. So cost of goods sold 20 lakhs. Cost of goods sold 20 lakhs. So with this cost of sale, we just add selling and distribution overheads. Selling and distribution overheads. That is equivalent to 10 per unit. 10 per unit of sale. How many units we sold actually? 20,000 units were sold. What is selling expenses per unit? Rupees 10. So 20,000 into 10, 2 lakhs. 20,000 into 10, 2 lakhs. So 20 lakhs plus 2 lakhs, 22 lakhs. So cost of sale, 22 lakhs. Plus profit, this is costing profit. You answer sale. Sale already given. that is 25 lakhs. 25 lakhs. Sale already given for 20,000 units, 25 lakhs. 25 lakhs. So the missing figure profit. The missing figure profit. So profit is equal to sale minus cost of sale. Profit is equivalent to sale 25 lakhs minus cost of sale 22 lakhs. 22 lakhs. So answer 3 lakhs. The profit 3 lakhs. So the profit 3 lakhs. Profit 3 lakhs. So the profit 3 lakhs. 25 lakhs minus 22 lakhs. The profit 3 lakhs. Profit 3 lakhs. Right. 25 lakhs minus 22 lakhs. The profit 3 lakhs. Profit 3 lakhs. Right. Now reconciliation statement. Reconciliation statement. You have to reconcile the profit as per cost accounts with the profit as per financial accounts. So reconciliation. Reconciliation. So profit as per cost accounts. Profit as per cost accounts is a starting point that we have derived now, that is equivalent to 3 lakhs. 3 lakhs. Profit as per cost accounts 3 lakhs. So add cost expenditure items. I told you already, cost expenditure item and financial income items. Financial income items. So those two items to be added. Those two items to be added. So what are the items to be subtracted? What are the items to be subtracted? Subtracted cost incomes and financial expenditure. Financial expenditure. Financial expenditure. So that is to be subtracted, right? What are the cost expenditure item? Cost expenditure item. Say for example, factory overheads. Factory overheads. So factory overheads as per cost records. As per cost records, factory overheads 5 lakhs. As per financial records, 4.5 lakhs. 4.5 lakhs. So 5 lakhs in costing. 5 lakhs in costing. 4.5 lakhs in factory. In financial. In financial. Therefore, factory overhead higher. Therefore higher. That's why it's called cost expenditure. We used to call over absorbed. We used to call over absorbed. Over absorbed factory overheads. Over absorbed factory overheads is equivalent to 45,000. 4.5 lakhs minus 4.5 lakhs, 50,000. 50,000. Right. Similarly, selling and distribution overheads. S&D overheads. Selling and distribution overheads. As per cost records, selling and distribution overheads 2 lakhs. But as per financial records, 2 lakhs. As per financial records, it's going to be 1,80,000. 1,80,000. 1,80,000. So difference 20,000. 20,000. Here also S&D expenditure in costing is higher than in financial. Again it is called over absorbed. Again it is called over absorbed S&D overheads. Right. Next. Similarly, closing stock. Similarly, closing stock. Cost expenditure and financial income, no, financial income. In financial, the closing stock is 1.5 lakhs. 1.5 lakhs. But in cost, the closing stock is 1,23,000. Therefore, in financial, the closing stock is 1.5 lakhs. In cost, the closing stock is 1,23,000. So, closing stock is always income, always income. Financial income 1.5 lakhs. Cost income 1,23,000. Therefore, financial, the income is higher. Therefore, financial income. Financial income is higher. The term used to call is called under absorbed or under valuation. Because cost it is less, no. Undervaluation of closing stock is equivalent to 27,000. 27,000. Right. So these are the items to be added. 3 lakhs plus 50 plus 20 plus 27. So 3,97,000. Right. What are the items to be subtracted? Subtracted. So cost income and financial expenditure. For example, office administration. Right. As per cost, office administration 1,93,000. But as per financial 2,60,000. So financial expenditure is more than in cost. Therefore 2,60,000 in financial. As per cost, it is going to be 1,93,000. Therefore cost to the expenditure less, financial expenditure. Therefore it is called under absorbed. Right. Under absorbed. Therefore more financial expenditure than cost. Technically we call under absorbed. Difference 67,000. That is to be subtracted. Similarly, goodwill written off. Is item only in financial accounts, not in cost accounts. That is 2 lakhs. You subtract. Next, interest on capital. So interest on capital only in financial. 20,000 less. So 3,97,000 minus 67 minus 2 lakhs minus 20,000. Answer 3 lakh 27 minus these items, answer 1 lakh. You have to subtract it. 3 lakh 27,000 minus 67 minus 2 lakh minus 20,000. The answer 1 lakh 10,000. This is what we derived. Just check it out. So we already derived profit as per financial accounts, net profit as per financial accounts, net profit as per financial accounts 1 lakh 10,000. Already we derived it. So profit of cost accounts is starting point are taken. Profit of financial accounts are derived. That's it. Let's start. The following information is available from the financial books of a company having a normal production capacity of 60,000 units for the year ended 31st March 2013. Sales 10 lakhs. 50,000 units is sold. There was no opening and closing stock of finished goods. Direct material 5 lakhs, direct wages 2.5 lakhs respectively. Actual factory expenses are 1.5 lakhs, of which 60% are fixed. Actual admin expenses are 45,000, which are completely fixed. Actual selling and distribution expenses are 30,000, of which 40% fixed. Interest and dividend received 15,000. You are required to find out the profit as financial accounts for the year ended 31st March 2013. So prepare cost sheet and assign the profit as per cost accounts for the year ended 31st March 2013. Assume that indirect expenses are absorbed on the basis of normal production capacity. See, we sold 50,000 units, but the production capacity fixed 60,000 units. So all fixed cost to be expressed in terms of production capacity, right? We'll see how to solve. Prepare statement of reconciling the profit as per financial and cost books, right? So let's start with that. Profit reconciliation we have to do. Before that, we have to prepare two things. One is financial account profit, another one is cost profit, right? First financial account profit. So profit and loss account you have to prepare as per financial books, right? So whatever the information given, we can straight away we can post, right? So this fixed and variable only for cost, not for P&L, not for financial, right? First one to direct material. So to direct material, it's clearly given 5 lakhs. So it is clearly given 5 lakhs. To direct wages, that is also given 2.5 lakhs. To factory expenses, actual expenses, this is actual 1.5 lakhs, right? Here you are not supposed to segregate into fixed and variable, that is only in cost books, not in financial books. Actual you can take. Similarly, admin expenses actual you can take. Admin expenses actual 45,000. Selling expenses actual you can take. 30,000. So by sales it is given for 50,000 units, it is given for 50,000 units, it is given for sales for 50,000 units, it is given 10 lakhs given sales. By straight away trading, no need to prepare trading and P&L, straight away you can put P&L account. To interest component. So by interest 15,000, straight away net profit we have, right? Interest 15,000. So total 10,15,000, total 10,15,000. Missing figure net profit. So net profit 40,000. This is P&L account, right? Now we have to prepare cost sheet. So cost sheet. So direct material consumed as it is, there is no change, 5 lakhs. Direct consumed 5 lakhs. Number 2, direct labor. So direct labor, that is also given as it is, there is no change for actual and estimation, 2.5 lakhs. So answer prime cost. So prime cost 7.5 lakhs prime cost. So add factory expenses. Here factory expenses we can divide into two categories. One is variable expenses, another one fixed. One is variable expenses, another one fixed. Now, so total factory expenses are 1.5 lakhs. Out of 1.5 lakh, 60 percentage are fixed, 60 percentage are fixed, that is equivalent to 90,000. Then 40 percentage are variable, 1.5 lakhs into 40 percentage are variable, the 1.5 variable, that is equivalent to 60,000. So variable 60,000. Out of 90,000, here we have to convert into, so this is given, so 1,90,000 is given, this is given for 60,000 units, this is given for 60,000 units. This fixed cost for production capacity, for 60,000 units is going to be 90,000 rupees, for 60,000 units it is going to be 90,000, but actually we sold only for 50,000, so we have to convert this one into 50,000 units. 60,000 units to 90,000, for 50,000 units is a question mark. So 90,000 rupees into 50,000 units by 60,000 units is equivalent to, so 75,000. So fixed factory 75,000. So total factory 1,35,000. 60,000 plus 75,000, 1,35,000. So total 7,50,000 plus 1,35,000, 7,50,000 plus 1,35,000, 8,85,000. 8,85,000. So this is going to be factory cost, or net factory cost, right? Next, administration expenses. Admin expenses here purely fixed. It's a purely admin expenses purely fixed. So purely fixed, it is purely fixed. Therefore, straight away we can convert admin expenses 45,000 we can convert into. So this is given for 60,000 units. This is given for 60,000 units. It is given, but we have to convert into 50,000 because it is purely based on normal capacity. So 45,000 to 50,000 by 60,000 is equivalent to 37,000. It's a purely fixed 37,500. 45,000 to 50,000 to 60,000, 37,500. So total 9,22,500. 9,22,500. Next, this is nothing but cost of production. 9,22,500. So add selling and distribution expenses. Selling and distribution expense also we can categorize into variable and fixed. So selling and distribution expenses 30,000. Out of 30,000, 40% fixed. 30,000, 40% fixed. That is equivalent to 12,000. So 30,000 into 60% variable. That is equivalent to 18,000. So variable selling 18,000. So out of fixed 30,000 into 40%. This is given for 60,000 units. But we have to convert into 50,000 units. So 12,000 into 50,000 by 60,000, that is equivalent to 10,000. So 18,000 plus 10,000, 28,000. So 28,000. So selling distribution expenses 28,000. Right. Next, if we just add cost of production plus selling distribution expenses, you will be getting cost of sale. Cost of 9,22,500 plus 28,000, 950,500. Cost of sale. So with this cost of sale, you find profit. Profit 49,500. This is, I'm just make it through sales. This profit is a missing figure. Sales I know. Sales value already we have 10 lakhs. Sales already we have 10 lakhs. So 10 lakhs minus cost of sale 9,50,500 profit. So profit is missing. We have derived sales minus cost of sales 10 lakhs minus 9,50,500 4,500 profit. This is as per cost accounts. Now we have to reconcile. Now we have to reconcile. So profit as per cost account, we can start with that. Profit as per cost accounts, we can start with that. So profit as per cost accounts, 49,500. 49,500 we can put it here. So profit as per cost accounts 49,500. 49,500. 500. So add cost, expenditure and financial income. Those items to be added. Added. List cost, income and financial expenses to be listed. What are the next? Interest only in financial income. How much interest amount? Income from interest 15,000. Correct, no? 15,000. So that is to be added. It's a purely financial income. Similarly, next, what are the items to be added? Just compare. Now compare factory expenses. Factory expenses as per cost 1,35,000. As per cost 1,35,000. But as per finance, it is going to be 1,50,000. So we have more financial expenditure than cost. Next, factory overheads. Factory overheads as per financial records 1.5 lakhs. As per cost records, it is going to be 1,35,000. It is called under absorbed because cost is less, no, under absorbed. So more financial expenditure, less cost expenditure. So under absorbed factory overhead is 15,000. That is to be subtracted. Right. That is to be subtracted. Next, compare administrative overheads. Admin overheads as per cost records 30,500. As per financial 45,000. So more financial expenditure. Therefore again less. Next one, admin expenses. Admin expenses as per financial 45,000. This is as per financial 45,000. As per cost, admin expenses 37,500. This is as per cost. Again under absorbed, more financial expenditure. The excess financial expenditure is excess admin expenditure is 7,500. That is to be subtracted. Right. Next one, we will see selling and distribution overheads. Selling and distribution as per cost 28,000. As per financial 30,000. 2,000 extra in financial. So selling expenses as per financial selling distribution expenses. Selling distribution as per financial 30,000. As per cost 28,000. This is as per financial, this is as per cost. Again under absorption of 2,000. Right. Rest of the incomes we compared. Now everything is over. Now we have to reconcile. So what are the figures we derived initially? So 49,500 plus 15,000 minus 15,000 minus 7,500 minus 2,000 so 2,000, so 40,000. So 40,000 will be the answer. This is profit as per financial accounts. So profit in financial accounts 40,000. That's it. Let's start. HK Piano Company showed a net loss of 4,16,000 as per financial accounts for the year ended 31st March 2013. The cost account above disclosed a net loss of 3,28,000 for the same period. The following information was revealed as a result of scrutiny of the figures of both the books. Factory overhead under record 6,000, which means expenditure in cost less than finance. Administration overheads over recovered 4,000, which means expenses in cost higher than finance accounts by 4,000. Depreciation in financial accounts 1,20,000. Depreciation in cost accounts 1,30,000. Depreciation in cost is higher by financial by 10,000 over recovery. Interest and investments financial income 20,000. Income tax provided financial expenses. Transfer fees 2,000. Transfer fees 2,000. Transfer fees 2,000. Income source adjustment credit in financial accounts 2,000. You have to prepare memorandum reconciliation accounts. Right. Let's start. So memorandum memorandum reconciliation account, memorandum reconciliation account, memorandum reconciliation accounts, memorandum reconciliation accounts. Right, now we can start with the two loss as per cost accounts. Loss as per cost, we can start with that. So loss as per cost accounts 3,28,000, 3,28,000. Here cost expenditure and financial incomes to be posted. Here cost income and financial expenses to be posted. Let's see one by one. Alright, first one, factory overheads under recovered. Factory overheads under recovered, which means expenses and cost less than expenses in financial. So financial expenses will be more. How much amount? 6,000 to factory overheads. So factory overheads, it is purely under absorbed by the amount 6,000, by the amount 6,000, right. Next, administration overheads over recovered. This is more cost expenditure, So admin overhead over recovery 4,000, over recovery 4,000, right. Next, depreciation as per financial 1,20,000, depreciation as per cost 1,30,000. But depreciation cost is higher by how much? Higher by 10,000, higher by 10,000. So by depreciation over recovery, depreciation as per cost 1,30,000, depreciation as per financial 1,20,000. So depreciation by cost 1,30,000 higher than 1,20,000 by 10,000. So 10,000. Next, depreciation is over as per cost and financial is over. Interest and investment not included in cost, is a purely financial income. So purely financial income by interest on investments, purely financial income amount 20,000. Next, income tax provided, this is purely financial expenditure. So purely financial expenditure. Appropriation of profit, profit we have to appropriate and pay to the government. Income tax 1,20,000. For reconciliation purpose, purely financial expenditure. Transfer fees. So transfer fees is a purely financial income, 2,000. By a store adjustment, credit is given. A store adjustment, credit in financial accounts 2,000. That is also financial income. Financial income. That's it. So here left hand side, it is not 2 by concept, it is left hand side, right hand side. 3,20,000 plus 6,000 plus 1,20,000. We just add, you will be getting. So 4,54,000. Here 4,54,000. So the missing figure, loss as per financial accounts, loss as per financial books. So the loss as per financial books, 4,16,000. That's it. Subscribe to our YouTube channel Stride Edutech and press the bell icon to see new videos.